Welcome to Season 4 of the Knack for Business podcast.
We have a question from the audience. How can you grow your wealth and secure your financial future beyond your own business without taking on risks you don't fully understand? Michael will unpack the differences between public and private investments, explain how to build a stable portfolio that aligns with your long term goals, and share practical strategies for small, medium business owners to create reliable income streams, even after they sell or retire from their business. Our guest today is Michael Latrobe from Parvis. In fact, Michael is a returning guest, and which is awesome. He's a seasoned business development professional and private market specialist with more than over a decade in experience in B2B sales, consulting, growth strategy for both major brands and startups. At Parvis, he guides investors through the private market with integrity, helping them build portfolios that truly match their goals. His approach is rooted in connection and understanding the shape of achievements that range from securing nationwide supply contracts to raising funds for community causes like the United Way. Known for his sharp analysis and unwavering ethics, Michael focuses on empowering people, not just chasing numbers, to create a future they can be proud of. He is returning to the Natural Business podcast, like I said earlier, from season 3, and that was episode number 90. Michael, welcome back. And do you have a favorite quote or saying, sir?
Oh, I do actually. Everyone everyone can achieve their dreams if they have the courage to pursue them. That's ad lib. In essence, it's Lizzie that came up with that many years ago. But it's pretty good. It's one of my wife's favorites as well. Probably why it's one of mine. She's very influential in my life.
From our last chat, has there been anything that surprised you lately in the investment markets? You being the seasoned entrepreneur and investor.
Not really surprising from how the private markets have reacted overall, because typically they tend to work in their own sort of lane. Overall, in economics and the finance world, what has been surprising me is just the barrage of tariffs flying around, which I feel does more harm to everybody than. But we'll see how that sort of attenuates itself once everyone gets settled and gets along again. But otherwise, it's been pretty much business as usual and steady as she goes on the investment side of things, especially anything that has to do with a lot of the services that are required on a day-to-day basis, or assets that are required on a day-to-day basis. So multi-residential family units, business services, industrial services, and infrastructure. Those are all things that, we do need every day. So those asset classes typically, as long as they were already in place, haven't really been touched all that much. So a lot of the newer things, that the new builds and the new developments that been affected a little bit, mainly on the supply chain side. But I don't foresee too many additional delays, because once they pivot, most of the time these new developments, they're pretty good at getting shovels in the ground and getting things started, usually within a pretty good time frame of what their original start dates were.
Has the politics in the world, without pointing south of our border, has the politics, because it won't matter because there are lots of large players out there. Has that taken something that used to be stable investments and made them a little more, not in doubt, but a little less strong or less
Mhm.
reliable?
Yes and no. I mean, so for example, there's one portfolio that I tend to work with. They're an income portfolio. I'd say about 40% of their portfolio is based in commodities, mainly in the energy sector, so oil and gas. And one of the key players in there is south of the border, so it did affect it a little bit, affecting the NAV somewhat, but mainly because of all that's happening, it sort of drove the oil prices down. Because it is commodity based, it drove the price of the NAV down. But all that to say, because of the way this portfolio in particular is designed, it always has a very steady income distribution to investors. So even though the NAV, or the net asset value of the fund, it might have decreased, overall, you're still making the exact same income you were making. It's just, if you're reinvesting those dollars to add some compounding, well, as the NAV goes down, you just buy more units. Then if once the NAV goes back up, it's worth more. So as long as you're not planning to sell that particular piece of your portfolio, you're not losing any money. You're actually making more as the NAV goes down, because your yield actually gets higher. So but otherwise, the only other things that would have affected some of the portfolios were maybe a little bit of the volatility from our currency exchange, from the different currencies, but because we do have a few portfolios I work with that are south of the border, but further south. And they typically raise funds in US dollars. So those investors I say were from the US, they're fine in Canada though, because of the fluctuations. If they would, if they invested earlier on in the year, it would have cost them more to invest that same dollar than it does actually right now, because right now the Canadian dollar is a bit stronger. So, other than that, there hasn't been really a whole lot of movement or uncertainty. The other aspect that has affected, not so much on the fund side, it's really just the emotional status of investors. So if they don't have an advisor sort of coaching them and letting them know all the ins and outs and how things are going, we have seen some pretty large withdrawals, especially on the institutional side, where they'll make large redemptions on real estate trusts, causing some, not instability, but that in itself will start causing uncertainties among smaller investors, wondering what's going on, even though there's nothing wrong with the assets. What's going on is because of the market volatilities, you have institutions doing redemptions to rebalance their own strategies in order to take advantage of the market conditions. So it creates a bit of a convoluted picture where people think things are failing when they're actually not. It's just larger institutions rebalancing things. I mean, I do it as well for my investors when I see market conditions that are favorable to do that, or we'll redeem on the private side, buy into the public markets, and then once that stabilizes, buy right back into the private markets so that they can keep getting that money growing in a stable fashion if ever things go sideways again. So there's a lot of back and forth, and most investors don't understand that aspect of it. So I do get a lot of questions about that.
Michael, with all the doom scrolling and thumb sucking that's out there, what are you excited about? What is actually lit up accidentally or on purpose that you didn't even expect?
Most recently, nothing really comes to mind. There's a few new developments that popped up in the woodwork that I started working with recently that are actually quite surprising, and I'm find surprising the appetite for them as well, especially from here in Canada. So we have some new developments that are being built in Mexico, some very nice residential developments attached to some eco-friendly commercial assets, all in a basically in a small community surrounded by jungle settings or near beaches, for example. So although overall the financial world looks like it's in a bit chaotic situation right now, there's still a lot of amazing developments popping up that people are still hungry for and are looking for to invest in, either from an income perspective or because they're looking to invest and then eventually acquire their own asset within some of these developments. So those are some of the things that I found surprising to pop up regardless of, because of the current situation, but it hasn't stopped a lot of these developers from pursuing their goals to get some great product out to investors and people out there. So it's been nice to see. Regardless of what's going on, they're finding ways to circumvent or bypass all the chaos.
If you're a business owner and you're,
Yep.
you're working away and listen, I gotta build up my portfolio for retirement or passive income. Where should they start looking? Like what's the target? Like, how much money should they set aside? What percentage that it's almost like having a reserve fund for the business or a reserve fund for themselves,
Yeah.
right? On hand.
Yeah. Well, the first step is getting a really good accountant that up, because as much as I can help them strategize and put a portfolio together that'll create growth on the front end and then some good income in a very tax efficient manner later on. It's still good to have an accountant involved to have that all set up, because as a business owner, the goal of being a business owner is eventually you want to sell your business, but you don't necessarily want to sell your retirement portfolio with it, because a lot of business owners, they'll use the the business assets or dollars to invest in, and but they'll keep it within the business, where instead of setting up a hold co for the business that can detach itself once you move on. Again, it depends on if the goal is to sell your business. If the goal is to sell the business, then you do it that way. Otherwise, you can leave it in the business. It's just you just wind everything down, and then that you keep your, instead of being an operating company at that point, you just re-register it so that's it's no longer in operation. But in essence, it always boils down to what kind of lifestyle they want to live, and how much after tax dollars you believe or you think you're going to need. Because everyone's a little bit different. Some people think they need $1 million a year, which is kind of a very big number. It's a little astronomical. I mean, some people, yeah, that's what they live on because they're very well to do. I'd say most typical Canadian entrepreneurs, medium-sized businesses, if they walk away from a business with several $1 million in the bank and can get that properly managed, they can live a very very lovely lifestyle, in on six figures a year pretty easily, and generally in a very, very tax efficient way. So depending on, again, it really depends on the lifestyle. So for example, I have a few investors of mine, they're all in the medical practice. So their goal is to, they won't need as much money as they have now coming in because their goal is to retire somewhere in Southern Europe, rent a little villa and probably because out there, I mean, I currently have investors that live there. It costs them roughly 2,500 euros a month, and they live like kings. And they have a two-bedroom condo on an ocean view. It costs them 800 euros. They go out almost every night. These two people. They're in Spain, and healthcare, they have a universal, healthcare insurance. It costs them 110 euros a month each. So they have everything covered, and then they have excess, for just over, a little under $2,500 a month, or 2,500 euros a month. So let's say $3,000. So to generate $3,000 in income is pretty straightforward. It's pretty easy. I mean, you could do it with as little as $500,000 that you set aside over time, and then make sure that that 500 generates, some decent returns. And typically with really well managed real estate and industrial services, you can do that pretty efficiently with little to no taxation initially, and then you can also benefit on some of these funds with their operational costs being flow through as a flow through to investors, where they can use, they get a TSA. They don't, not that they pay the costs, they get a flow through of the costs to be able to apply to their own taxes. So they get a tax write off every year on top of it, which is approximately 10% of what they invested in the first place. So every investor is a little bit different, but I'd say if you had, entrepreneurs, if they aim to have, between a million and $2 million set aside, properly managed, they could live a pretty good lifestyle, as long as everything else is paid for. And again, depends where they want to live. If they want to live here in Canada, they might need $50 million. I exaggerate, but at the end of the day, it really boils down to what do you need. I mean, I use myself as an example a lot with my wife. I mean, she works at the government and immigration. She helps a lot of people there. Eventually, when she retires, yeah, she'll have a pension. I'm also building our retirement fund, but by the time we retire, we know what we're going to need for retirement. And with as little as $5,000 a month, where we're planning on living, we're going to live very, very well, and we'll be fully covered from a health perspective, not having to wait in lines in hospitals and clinics and such. So, I mean, well, we might actually have a better lifestyle where we're going than where we are currently. Although, I mean, we do enjoy Canada and our lifestyle here. It's just it'll probably be a lot easier in other places. So once we decide to retire.
I certainly don't know your business, but I know your industry. And I would think one of your biggest challenges, and I'd love your feedback on it, is clients who either lie to themselves or to you about their risk tolerance.
Yeah, that's a big one. I wouldn't know that they pardon, that they would necessarily lie about it. They just probably don't understand what their own risk tolerance is. So a lot of times, what I would do is I ask the question, because sometimes they'll encounter an investment they want to get involved with that I have questions about, and they were sold this idea of an investment, not necessarily through me, but through another entity from marketing. And so, because I'm sure you've seen lots of Instagram posts recently over the last 6 months, all kinds of real estate investment opportunities, from apartment REITs to vacation rentals to built to purpose Airbnbs and campgrounds and all kinds of things, right? So people sign up, they get sold the idea, And then they get to that question about risk tolerance, and because they were sold this idea, they think, oh, there's no risk because this person has done this forever and forever and a day, and what could go wrong? So I was asking them, I said, well, if that, let's say $50,000 today that you invest, let's say next year it's gone, just gone. How does that affect your life today? Like, how is that going to affect your life today, and how long will it take you to recover those dollars? Is it going to matter? Will it will you know so um and then they'll take a few minutes to think about it, typically, because I tell them, like, literally it'll be gone. So if they can't answer that question with a solid response, or at least a plan on how to recover it or how it would affect them, then they're not ready. Just because people that are ready to take on risks, they'll understand the risk, and they'll understand that, yeah, if we lose this money, there's going to be a bit of a change. Will it be a big change, or will it be something that just doesn't really matter? Because every investor is a little different. But investors that are just getting started, well, they'll crack under that question. It's happened to me, actually, probably about 3 months or so ago. There was an investor. She came to me. She was quite keen on investing in a project out west. And it's a beautiful project. There's nothing wrong with it. It's actually a great project, but there are qualification processes to be able to invest in the private market space. And as an advisor, I have a duty to make sure that people don't overexpose themselves to unnecessary risks. In her case, she was sold the idea that she could put her entire RRSP into this investment, which basically equated $75,000. A 40-year-old single mom, and I said, "Well, what happens if you lose all of this money?" He said, "What do you mean?" He's like, "What if next year the fund calls you and says, 'Oh, by the way, development got kiboshed and we lost all your money. What do you do?'" And she went pretty pale. So I mean, I always broach that subject just because it is it's a distinct possibility. As much as people have experience in building things and managing things, it's just there's always that possibility, whether it's private markets or even the public markets. Public markets, we all see it up and down, up and down. I mean, I've seen people lose entire fortunes in the public markets. So when people say the private space is more risky, I said, well, it's more risky in the sense that you might not be able to get your money out in time before things fail because you won't know they're failing. In the public space, you can watch it fail. You can watch it fail all the way down, and most people do. And then they'll sell when their $10 share they bought is now worth 20 cents, and they'll complain about it. It's like, but you had all that time to pull your trigger, but then you were emotionally attached to something that you probably shouldn't have been. Whereas in the private space, reporting is usually done on a quarterly or biannual basis, depending on the types of developments and projects and properties and such. So my job is to try and get as much information as often as possible from all of these things so I can keep informing investors, and I keep an eye on that stuff. I mean, knock on wood, I've only ever had one project where it went sideways, and that was strictly because of COVID. Everything else I've done in the last 10 years, no one's ever lost a dollar. They've actually just kept growing. So, well, let's say this young lady that with her RSPs, after I asked her the question, she said, "Well, that would probably be pretty devastating because that's all I have right now, and to rebuild that, I might not be able to get that back by the time I retire." I said, "Okay, so here's what we're going to do." So typically, I only allow investors getting started in the space to invest up to 10% of their overall liquid assets into the private space just to get started. So if you're really keen on this investment, do $7,500. Well, their minimum is 50. I said, that's fine. I'll call them. I'll ask them if they'll accept 75 just to help you get started. That way you can at least participate. And if they don't want it, then I'll find you something else that's similar or better, and we'll get you started that way. Because at the end of the day, my job is not to take all your money and invest it into a slew of different things that may or may not function. My job is to find assets and investment opportunities for investors that work for them in a way that they can count on it, 10, 20, 30 years down the road, and not have to worry about it disappearing overnight. So I'm a big fan of things that are already in place. New developments are great, but overall, when I'm doing the portfolio strategy, 40 to 50% maximum is usually going into the private space. And any one issuer or one, I guess, one investment, I guess you could call it, never more than 10%. And then that way you get some good diversification, and you're never overexposed to any undue risk. I mean, there's always a risk, but however, that way you can really sort of see a few things, and I make sure that they understand what they're investing in. Nothing worse than not knowing what you're doing. It's terrible.
Just for clarity's sake for the listener, define liquid assets.
So liquid assets would be anything that you could sell today or tomorrow and get cash for it. So in essence, anything that's in your bank account, your RRSPs and TFSAs that are in the public market space. So like stocks, bonds, mutual funds, GICs you can liquidate, before they mature, that's their penalties. But I'd say anything that you can just sell off tomorrow and get cash, whether it's at a gain or a loss, doesn't matter. But anything that's liquid, that's easily liquidable, is a liquid asset. So that would be what we call your net financial assets. Anything else outside of that, like homes, properties, those are also they're net assets, but they're not liquid. I mean, you can't sell your house tomorrow, right, overnight, and get the money from that. So I mean, depending on the market conditions, but by default, properties are not considered liquid assets. That's why when I calculate how much people should be investing into different asset classes, I always base it on what they have as far as liquidity. I can compare their overall strategy to what they have in equity, but typically equity isn't always easily accessible, so that's not considered liquid. But at least it's a
So
fallback position if ever, say, something were to go sideways in one of the investments, and then later on they need to pull equity, or they sell a home or a property, then they have a lot of cash that comes in, then they can remaneuver into different assets then.
so you kind of just touched on something earlier, different asset classes, different risk levels. And to me, I had one guy come up and say, "Do you want to talk to me about crypto?" And I'm like, "No." And for a couple of reasons. One, I don't have the correct knowledge base, right? And to play in that space. So to me, that is a red flag. But when
Yep.
you're looking at things, and someone says, "Hi, I've got something to invest in," or someone says, "Listen, I heard about this. Help me invest in this." What do you do for a? And that's some assuming that yeah, everybody's finding red flags, but sometimes too good to be true moments do exist, right? That Nigerian princess, apparently,
There's
or
lots
there's
of those.
or there's someone has passed away, but you're the long lost relative. For a mere $5,000, you'll get 1 million back, right? A good
Yeah.
return if it were true. What do you do? Like, how do you figure out that's good, that's not good, assuming that the risk tolerance is in alignment with, the perceived risk tolerance is in
Yeah.
alignment with the investment.
Well, one of the first things they typically do, so working through a brokerage, I usually keep a pretty narrow roadway as to what I'll expose investors to. But I do have investors that come to me with things that are not necessarily on the shelf. So then what I'll do is I'll do a little bit of background research on it initially myself. And then depending on who's involved at the management level of the organization that they're looking to invest in, I'll definitely do some research on those individuals. But then I also verify if this fund itself is actually registered through securities. Because in the private market space, there's a lot of fly-by-nighters, Uncle Joes, Uncle Sam's, Aunt Jemima, whatever. But there's a lot of these folks that they raise money for small projects, and either whether it's they want to build a sixplex and are looking for someone to do it, let's say joint venture. I mean, there's lots of those, and that's fine. When people, they'll do small projects, but it's when you have individuals doing heavy marketing and trying to raise money for this project, and they really really large returns overall. It almost feels, like I said, too good to be true, and in some cases, to me, it almost feels like a timeshare hardcore sales pitch. And
I wanted
I have one of those too. It's a lovely, lovely timeshare. I got lucky with my negotiated a few things, but that's beside. So when I look into these different opportunities that might pop up, I'll do all that research, and then I'll also encourage the investors to do a lot of their own, or I'll point them into a few directions and send them a few links to look into, because sometimes um, just because it's not necessarily within my purview or on the shelf, say at Parvis, doesn't mean it's a bad investment. It just means that we can only have so much. I mean, I can only know so much about so many different opportunities. So we cherry pick what we want and what we want to have on the shelf and what we want represented. And so what I do a lot of times is I'll see who's representing these different assets that they might bring into my purview. And if there's people I know that work within those organizations, then I'll call them. I'll call them if I know all the facts, and I'll have them send me an offering memorandum so I can go through it and see how it's structured and what investors can expect, and if it's very legitimate, and then verify all the legal aspects of it. And then again, just the big one is make sure that they're registered, especially when they're asking large sums of money, because or even small sums. I mean, if you go to there's a lot of sites out there now that do startup raising, and people can just get invested into any kind of startup they want, with as little as $100, which is fine. I mean, for, for a lot of people, $100 is not much. They'll try it, and but they always think they're going to get wealthy or really really rich. Investing $100 doesn't quite work that way unless you hit a unicorn, and even then, if you're
Ticket.
more money spending $100 on lottery tickets more likely than most startups that show up on platforms where they're fundraising. Because it takes time for a lot of these startups to actually get to a point where they're going to make money. And in some cases, they just never do, never get past that finish line. So it really boils down to, as long as the risk aligns, just doing all of that due diligence and research. And there's a lot of work there to do, because the biggest the I guess the biggest risk always lies, in my mind anyway, within the management of the fund. Who are the managers? Who are the principals running the show? Because at the end of the day, I mean, I've seen funds where I was previously, the accounting team, legal, they did all the due diligence. Everything looked great. It was fantastic. But then you don't always know what's going on in the minds of the management. So, for several years, things could be like clockwork, everything's running as it should be. But then all of a sudden, one of them has a brilliant idea to deviate from what their memorandum was of what they're supposed to be doing. And then they just sort of slightly deviates towards something else that they think could benefit the fund, or they get bamboozled into it, and then all of a sudden they lose all that money, and all of a sudden the fund's in trouble and investors lose their money. I've seen a few of those happen, and it's usually at the management level when that happens. So that's why it's so important that when you do have management, you also have an oversight committee who are not related to the fund. So those are two very important aspects to look at, because you want people that are not involved in the fund directly, but are professionals in their fields that know all about it. Basically as chairmen, so that they or chair people, so that they they can keep things on track, because as soon as things go off track, they can continue going off track a little at a time. And most people wouldn't necessarily notice it until it's too late. I mean, thankfully, I've never been involved in any of those, because sometimes that happens with funds that are too complex. When they're too complex, I don't try to break my noggin on it, because if I have to spend days and weeks trying to understand an investment, I can just imagine how the investor's going to feel and how they're not going to understand it. If they don't understand it, that means they're not going to sleep at night, and I'm the one who's going to be getting those phone calls, and I'm not going to sleep at night, and I don't want that either. I need my beauty sleep.
Michael, I'd like to ask you an overview question as an outsider that I think is accurate, but may actually be wrong. It seemed like 30 to 40 years ago, point of private investment was to actually get big enough and good enough and known enough to go public. And it seems that those IPOs are less attractive, and there are good reasons why they're less attractive, but they're less attractive as a venue than they used to be. Is that fair, or is that just coffee shop talk?
Well, I mean, it really depends on what the goal of the company is within the private investment world. So, for example, what happens is when you go IPO, then there's a whole other layer of rules and regulations and oversight that come into play, which is actually quite costly. So the companies that do release IPOs, that do go public, typically is because they're looking to raise a lot of money to keep things moving forward, to scale to a scale that greatly surpasses what their current economy that they're looking at as far as growth is concerned. So the world that I typically work in the private placement world is, I'll work with economies of scale that typically smaller than that. Not to say that I don't work on raising funds for startups that could eventually get to that point, but most of the funds that I typically work with, they stay to a scale that's more of a, I guess, a local, just in some instances, it's like a provincial level economy. Others, it's national. In some cases, it's more like North America. It really depends on what the purpose of the fund is itself. I mean, there's one real estate trust I work with. They're just over $9 billion under management and properties, but they have properties all over Canada. They even have some in the United States. So, but they're never going to go public because it's actually more efficient to keep it private for the fund, and investors actually get better returns because as soon as you take things public, well, we see how the stock market reacts to, someone sneezing. All of a sudden, an asset that was generating income and growth for you year over year over year over year without fail, all of a sudden is public, and now you're 30% in the hole. So the only advantage that the public space brings to investors on the investment side is that liquidity aspect where you can, buy today, sell tomorrow, get your money back. But that has a cost, and that cost is called volatility. So if you want consistency and, you know, continuous growth, typically boring asset classes is how I call them. Boring assets just keep on trucking that provide really basic services or basic needs to a community. Those are the ones that just keep paying continuously. And unless they're looking to expand globally, they would never go IPO. But I would say the appetite for IPOs now is probably diminished from the big tech sector booms and such, just because one of the costs, and well, there's a lot less, I guess you could call, free money floating around to invest into these things and just pump into them to get them to a point where they can be, they do make it to the public space. But I mean, if you look at most of the IPOs that have gone that route in the last decade, especially in the tech sector, I mean, none of them are actually making profits. They just keep burning money. I mean, they do great things, but they're not technically making profits, right? So investors don't really benefit. I mean, yeah, they benefit whenever the value of a stock goes up, but the only way that you capture value in an equity position like that is if you sell. So you have to be willing to sell. Most people aren't. They get married to their stock and keep praying and hoping and thinking it'll just keep going up. In some cases it does, in some cases it doesn't. I'm a big fan of cash flow. Cash flow is one of those things that it generates cash. Cash drops into your bank account. Cash gives you options. You can invest into that stock you love. You can invest into something else that generates more cash. If you don't have cash flow, you don't have options. The only way you make money on equity is if you sell. Bernie, you mentioned crypto a while ago. There's some aspects of crypto that are pretty interesting. They have mechanisms now where you can generate cash flow, but typically crypto, you only make money if you sell your coin. So people that tell me they have hundreds of thousands of dollars worth of crypto, it's like, great. How do you use it? You can. I mean, because if you buy something with it, you lose it. If you want to capture that value, you have to sell it. Are you willing to sell it? They're like, no, I'm going to keep it because it's going to keep going up. Like, that's great. That's wonderful. So how do you use it in the meantime? I mean, banks won't allow you to leverage it for loans, right? So until you can actually capture that value, I mean, to me, if it's not generating cash flow, it doesn't really give you options. You're kind of stuck. So, I mean, I do have crypto in my own portfolio. I mean, a little bit, but I also invest into companies that leverage crypto for services. Those
Uh,
move up and down, and those generate income.
so it's like having a piggy bank, but if your piggy bank's hooked to something that can ebb and flow the cash from it, then you
Yeah,
can make coin. Hey, you just enlightened me a lot more than I knew about this morning when I got up and had my first round of coffee. So, Michael, thank you so much.
no worries. That's what I'm here for. At the end of the day, I have these candid conversations with people that are looking for advice, and an advisor that can sort of, that vibrates at the same frequency that they do, because most people, once they understand a lot of the concepts, it's really easy to put into practice. I just guide them through it and get them involved, and off they go. And after that, it's pretty straightforward.
So, the upcoming things that are happening inside Canada right now, and probably other countries too. there are new projects that are coming in, right?
Mhm.
There's new impetus to do national projects on a large scale. You hear about the Port of Montreal getting
Mhm.
expanded, right? Stuff
Yep.
like that. All good stuff. Are there opportunities that are coming up from an investment side?
There are
Uh,
actually,
yeah.
but there's definitely gonna be opportunity there. It'll really boil down to a lot of where the work's gonna be sort of handed out to. So any companies that work in infrastructure, construction, manufacturing, especially the manufacturing of steel parts and anything that has to do with putting up buildings, they'll be busy and they'll be busy for the next 5, 10, 15 years more than likely. So a good way to get involved in that is, yeah, it's sort of, you don't necessarily need to find the exact company because there's a lot of funds out there that you can invest indirectly into all of the different companies, whether it's in the public space or even in the private space. In the private space, there's a couple of private entities that their purpose is to acquire and run companies in the construction space. So there's one in particular out of Alberta. They're called KV Capital. What they do is they acquire, run, and manage companies in residential and commercial building space. These companies, they can either manufacture, they do the installation services, maintenance. So they look for companies that they can add their portfolio that they manage. Because a lot of times you have a lot of these great companies that have 100 plus employees that have been run for 20, 30, 40 years by one person, but they're not taking it public. They don't know who to sell it to. Their kids don't want to take it over. They don't have a transition plan or a continuity plan. So then you have funds like this one where they'll they'll buy your company, and as long as all the numbers make sense, obviously, but they'll buy your company. They put on quote unquote golden handcuffs just so for the transition phase. They really learn everything about how your management style and what they can do to help make it more streamlined. And then they take over, and then they put other management in place. So they really just build a good portfolio of these companies, and eventually their goal is to eventually also sell these companies to a larger entity that keeps managing it. So they grow everything and sell it off. That's how investors also make money from this particular fund. So finding funds like that invest into companies that do construction, manufacturing, infrastructure, that will be an opportunity for investors to get involved at several different levels within our growing economy, to be able to benefit from that. It's just you need to be picky and choosy about which ones because not all of them are going to be created the same. And then you have to, again, it's all about who's managing the show, who's running the fund and making sure that they're making the right decision. Because again, couple of wrong decisions, almost, akin to fraud in some cases, I mean, then you can get yourself into trouble. Not legally, but as an investor, it's one of those things where if management isn't properly managed, then, it doesn't take much to commit minor fraud in some cases. They might not think it is, but in some cases, because they're not following the mandate of what their offering memorandum says, it is technically it could be akin to committing fraud. So that's why it's important to always do that due diligence on the management side and make sure they have oversight.
One
Lots
of
of
the
opportunity.
one of the reasons to go on a podcast is to inform and educate. And another reason to go on a podcast is to find people who are looking for an opportunity you can serve. Another thing of a podcast can do is you can clearly lay out who isn't a fit. And I have a feeling that you have some pretty specific answers of who you would recommend to someone else and not you. Tell me about who isn't a fit, Michael.
Wasn't a fit for someone like myself?
Or actually, not someone like yourself. You have people who you aren't a fit for, and there are some reasons. Tell me those.
Yeah, fraudsters. Yeah, no, I'm not a big fan of yeah, definitely not fraudsters. Fraudsters are not definitely not on my priority list. Let's put it that way. I, I work very well with small medium sized business owners, having been a business owner myself. Even just regular, employed individuals and families are always a good fit as long as they're willing to take the time to read and understand and walk through a few different processes and know what to look for. Because when I do take on clients, I help educate them on what to look for when they're looking at all this different documentation, especially offering memorandums. They can be quite thick, It's like, it's akin to reading The Lord of the Rings, except not as much fun. Uh, and so then I show them the big points where they want to look at and what they want to look for whenever they want to do a review. Although a lot of the time I'll pull that out for them and show them, the ins and outs and what's good and bad about, a particular fund. So what's good as far as why they're running it this way and why it's designed this way versus what are some of the risks associated to it and how they mitigate those risks, because that's a big one. It's how are they going to mitigate the risks involved in, say, running a real estate trust. There's always risks, obviously, tenants, maintenance, all those things. So how do they mitigate those things? Because they always have, they have, here's what could happen, here's how we're going to prevent it. If they don't have a here's how we're going to prevent it, you stay away. Otherwise you're in trouble. But typically people aren't necessarily a good fit initially for me. Would be people that are that so we talked about liquidity earlier on. If you don't have enough liquidity initially to get started, it might not make sense to get started with someone like me right away, especially in the private capital space, just because some of the minimums tend to be higher. You can't just put in $50 a month into it and go like that, right? Because one of the ways that in the private capital space they help to ensure, or they push out the better returns more consistently, is they keep a lot of their costs down. Administrative costs are some of the highest that any fund can look at. So if you look at, on the stock market, you can buy and sell shares all day long, but every time you do that, there's an admin cost there to the investor, to the bank, to the institution that issued the shares. There's so many costs there. It's like mutual funds, tons of costs. So by the time your money actually gets to the investment, it's already probably been chewed away by about 30%. Um, so in some cases less, but even EFTs, I mean, EFTs are a great cost reduction measure for when it comes to investing in the public space, but there's still costs there. And most of it is admin fees or admin costs. So on the private side, to reduce those, that's why they have typically, minimums, and typically, you're looking at $5,000 to $10,000 minimums, and more. You can only your start date on an investment is on one particular day of month, right? So you get all of the paperwork done and you get the money in place before, say, the 22nd of the month. That way, if the money is there on the 22nd, perfect, you're invested. If it's not, you have to wait till the next month for the next closing date. So that's how they reduce those costs. And then same thing when you do a redemption, same thing, you put in the request and then you'll typically, depending on the redemption schedules, it could be monthly, it could be quarterly, really depends. That generates some planning for investors, which I help them with as well down the road. But people that don't necessarily have that liquidity in place, sometimes it might not make sense to get invested right away in the private space, especially if they're doing it through registered funds. Because with registered funds, unlike the stock market or with your bank, you can't just open up an RRSP and just drop it in there, because for in the private space you need what we call a trustee. So the trustee keeps the registration of your funds in place intact while it's invested in the different private assets, but the trustee has a cost. It's an annual cost that the investor pays directly, and you pay it indirectly when you're dealing with your banks and mutual fund advisors and everything else. But when you're doing it yourself, because it's self-directed, you pay that fee, which is 100 and, on average about $180. Let's call it 200 just to make the math easy. So if you know that you're gonna have, it's like a bank fee. So if you know you're gonna have that $200 fee annually, you wanna make sure that the dollars that you have in there generating returns is enough that, you kind of offset that. But if you're starting with $5,000 and your investment generates, say, 10% a year in return, well, that's $500 minus 200 for your fee to keep your trustee in place. So you're in essence only really making 300. So that is like, does it make sense to go through that entire process to make basically the equivalent of 7%? In some cases, the answer is yes, it's fine. But as long as people understand that, everybody does. Another not good fit would be people that aren't coachable, I would say, or people that are willing to sort of learn and understand a lot of the different processes and understand why these processes are in place. Because I've had pushback in the past with individuals that were sold the idea of an investment before coming to me, and then would get really upset with me when I would tell them no. Literally. And so when people aren't willing to listen to and understand the why of the no, it's like, okay, well, if you want to lose your money, then and sign off on all of your rights as an investor to protect yourself, then go right ahead. I'm not going to stop you, but don't call me again for advice because you're not willing to listen or understand the role that I play to help protect you and ensure that you keep making money, as safely as possible. But at the end of the day, people that aren't willing to have those conversations and feedback and just take the time to understand things, yeah, they're not typically a good fit for me. Although I'm pretty diplomatic most of the time, but I've fired a few people. I fired a few people because again, I take a position of education versus trying to sell you something. It's unless you're very very wealthy, then I'll try to sell you something that would probably benefit you anyway because really wealthy people tend to think they already know everything, although they do know a lot. Sometimes there's aspects they hadn't realized, and then when I bring it to light for them, then it's very helpful. Like a lot of the tax efficiencies and a lot of the new structures in place with some of the real estate trusts I have with the flow throughs. They didn't used to have those before, or didn't really put it out there all that much. But if you're getting an extra 10% on your invested assets as a write off, and you're in a high tax bracket, that's for a lot.
You just mentioned something interesting. We're getting close to the end of the podcast, and I'm like, oh man. So here in an information-rich environment provider, thank you. Flow-through tax credits,
Yeah.
FTSs, I believe they're called. I understand it's good for mining and oil. There seems to be a push afoot uh, to do that in the tech sector. Would that provide a new horizon, a new boon?
Yeah, I don't know how that's necessarily gonna work in the tech sector. I don't know how they would frame it because the with oil and gas, what happens is oil, gas, minerals, the flow through shares. The reason there's flow through shares is because a lot of times these companies are very, very capital heavy. They typically never make money until they find something. So very exploratory. So they get a lot of tax credits and subsidies from the government. So what these companies do is they flow all of those tax credits and subsidies over to the investors. So as an example, as an investor, if you were to invest in, say, mining flow throughs, you're looking at, depending on where you live, which province you live in, you can get up to 140% tax write off. Right. So you may not make money on that investment. However, you're getting a whole lot of tax back depending on your tax bracket. So it's really just a tax vehicle in most cases. For most investors, not really something they should probably venture into unless, they're paying lots of income tax. And at that point, yeah, invest into something. If it works out well, the worst in a best case scenario, you make good returns. And sort of the middle of the line road, you'll break even. In a worst case scenario, you might lose the equivalent of 20% of your initial investment after, but you'll most of the time you break even because of all the taxes you've already received back in at the end of the day. So for example, someone who's in the top tax bracket invests $100,000, they're getting $50,000 back from the government, right? That first year. So again, you have a choice. You can either give $100,000 in taxes to the government, or you invest 100, get 50 back from the government, and then you really have 50 at risk. And typically, that 50 at 50,000 will keep trucking for a few years because most flow throughs they mature after a year, after 2 years. And then you can roll it into, say, if you want to save more taxes, there's a mechanism where you can roll those and as by gifting them to a charitable organizations, we get additional tax credits back. So there's full mechanisms. Again, it's strictly a tax strategy. The other flow throughs that I had mentioned earlier when it comes to real estate trusts, for example, is they flow through their expenses of operations to investors. And typically investors are looking at about a 10% equivalent of what they actually invested. As an example, I have a doctor of mine that I work with. She had invested $200,000 last year into a fund. Now the fund was was newly put together. The company's been around for a long time, but this was a new fund for a particular asset. So all the startup costs of the operations and setting up the fund, it's pretty cost heavy on the front end. So her tax receipt for that, she received a 27% tax break on her $200,000, meaning she got a T-slip for a $54,000 write-off
Huh.
on top of her 18% annualized return. Now, every year moving forward, her tax receipt will probably be about the equivalent of 10% of her 200. So that means every year moving forward until the fund is wrapped up, she'll be getting her returns plus a $20,000 tax receipt. So, I mean, that can be worthwhile for a lot of business investors, even people that are at the end of investing and have a wad of dollars that are looking for a tax efficient way of investing those dollars. I have some pretty great products out there that do that. The returns initially are what we call return of capital. So there's no taxes on that initially. You only pay taxes probably 12, 13 years down the road, and that'll be capital gains. But then you can offset the capital gains with the cost flow throughs. So it's a pretty great mechanism that they have, but it's because they structured as a limited partnership. So then as a limited partner, you get to participate in that flow through, which is kind of nice. Then again, those are things you can't do with registered funds because with registered funds, it's already tax exempt. But so when you have mechanisms like this, it actually makes more sense to invest outside of your RSP because you get that tax break every year, not just the one time you deposit it.
Michael, if this resonates to a listener
Mhm.
and says, "Yeah, I think I understand. I want to know more," how do we get a hold of you?
The easiest way is, well, you both have my contact information. If you speak to them directly, you can just give them my phone number or my email. But the best way to reach me is definitely by email at michael.latrue@parvisinvest.com. Otherwise, phone calls or a text message. Text messages are usually better. I get so many phone calls from scams and everything else. So I typically, if it's a number I don't recognize right away, I'll either screen them or ignore it unless there's a message. So text messages work really, really well. So yeah, my number is 613-50631. Otherwise, email is a pretty good way to do it, or just reach out on LinkedIn. LinkedIn's a good way to do it as well.
Michael, thank you so much again for being a guest.
You're very well. Well,
My
thank you for having me. It's always a good time.
To my co-host Wayne Pratt, thank you, and especially you, the Knack for Business listeners. If you're finding this of interest, Michael's the person to reach out. He works with entrepreneurs, small business owners, turning that idle cash or, have your accountant as part of the picture. But Michael can find some paths to help you achieve your goal and save cash downstream, whether it's not dodging tax, but not having to pay full freight when you don't have to.
To reach the podcast hosts, email them at info@creativeinsight.com or by the website creativeinsight.com, spelled KREATIVISIGHT.com. To reach Wayne at his email, wayne@motive8u.ca, that is MOTIVE, the numeral 8 and the letter u.ca, or his website, motive8u.ca. If you would like to be a guest on this podcast and share your knowledge, let us know. We would also appreciate your feedback on the content or format. Check the show notes for more details. For these podcasts, we like to acknowledge the support and thanks to the following people. Carl Richards from Podcast Solutions Made Simple, a renowned podcast expert. Fred Crouch, who is the Property Wizard podcaster, where Bernie is a co-host. Jovan Strika from At Hive, a co-working space that is more than just a space. Then Melanie Weber, Bernie's invaluable business partner, and Wayne Pratt from Motive8U Inc., who serves as both a coach and co-host of these podcasts. Disclaimer. Please note that the Knack for Business podcast episodes are meant solely for educational and general informational purposes. The information and opinions contained within are not intended to be professional advice on any subject matter. The thoughts, views, and opinions expressed by the participants are their own personal beliefs and do not represent the views of the podcast hosts or any affiliated organizations. It is important to note that this podcast is not a replacement for consulting with certified experts in your area who possess knowledge of your unique situation. The hosts of the podcast, along with any participants or affiliated groups, do not take responsibility for any actions taken or not taken based on the information presented in this episode. It is highly recommended that individuals seek guidance from their own personal advisors in fields such as accounting, law, or other pertinent areas prior to undertaking any actions or making decisions that may impact their financial, legal, or other aspects of life.